Safe. We're going to continue our weekly discussion here on real estate, interest rates, and definitely the macro environment here in Canada. And we're going to really focus on here is whether a recession is on the horizon. And as you can see, the title of this article, Canada to enter mild recession in 2023. And this is according to Desjardins and economists. So I'll definitely take you through what they're saying. And I'll take you through the data that you'll be able to make a maybe more insightful decision based on what we're seeing in the real estate market, along with what we've seen in terms of profit reported here by RBC and the other big banks. That's a very telling sign. And I just want to talk about a little bit of other topics that really maybe pointing the part that we're entering a recession. We're obviously in a slowdown. There's absolutely no doubt about that. And also a little bit about what the Federal Reserve said in the U.S. on Friday. So definitely stick around for the whole video. I'll have my links for Instagram and Twitter. If you ever want to reach out to me, ask any questions you're curious about, please do so. And also I'll have all the articles in the description as well, so you can read at your pleasure. So just before we begin, just a bit of a caveat. I am a wealth management advisor. I do this day in, day out in terms of working with clients and research. So if you're looking for trusted advice, I would say reach out to someone you can work with, someone you can advise you, and I'll definitely share with you my perspective here as we go throughout this. So let's kick it off here. This is an article from Thursday, August the 25th. As mentioned, Canada to enter mild recession in 2023, and this is from Desjardins economists. And let me just take you through high level what they're saying. So they're predicting that Canada will enter recession in the first half of 2023, and this is based on obviously the interest rate hikes we're seeing, which has led to a cooling housing market and weak growth in the United States, drag on the country's economic outlook. So obviously the Canadian economy is very heavily dependent on the US, and the US is slowing down as well. In a report released Thursday, Desjardins economists said bringing soaring inflation back to 2% obviously won't be easy, and that the concept of a soft landing where inflation is tamed without leading recession has become increasingly unlikely. Canada's economy, like so many others, obviously seems to be entering a slight downturn that could reach its nadir in early 2023. And in their opinion, this decline is a necessary evil and help offset some of the imbalances that are feeding inflation. So as I've been sharing with you for weeks and months, inflation is the biggest challenge. That's what all the federal reserves or central banks are focused on, and that's what they need to fix in terms of making sure things are stable from that perspective. So we now expect the Canadian economy to tip into a mild recession in the first half of 2023. While Canadian inflation has slowed down to 7.6% in July, the Bank of Canada has signaled continued interest rate hikes are necessary to taming soaring inflation. They're expected to raise this by 3.25% by the end of fall in terms of their overnight rate. And which is good, Desjardins notes will put further pressure on the Canadian real estate market and weigh on household spending and business activity. But the real factor here weighing on growth will be a cooling housing market. I'm going to take you through some of the statistics very shortly here. Since hitting a peak in February, home sales have fallen 31% nationally and prices have dropped 17%, the economists have noted. So housing, real estate, that activity has a huge factor on our GDP and obviously on our economy. And that's already slowed, and in their perspective from Desjardins economists, it's obviously going to slow further as we're going to see more interest rate hikes. The next announcement here is on September the 7th. As we continue along, this article really firms up the point that Desjardins was painting, and let me take you through this. This is from Friday, August 26th. Canada's real estate market is cooling. Here's what to expect this fall. So after fueling, obviously, Canada's economy through the pandemic-19, the real estate market is showing weakness as home sales fall and bidding war obviously, are less and less. It's welcome news for prospective buyers hoping for a better price, but as the busy fall season nears, economists and realtors are at odds at how long the pricing slide will last and how long it will go. The fall is obviously an interesting period because you see more buyers jumping into the market, and you don't need a ton more buyers to provide a little bit more stability to prices. So it's really looking for that evening of the price. Right now it's obviously up and down. The average home price is above pre-pandemic levels still, but increasing mortgage rates and inflationary pressures are weighing on the market. When the pandemic began in 2020, the Toronto Real Estate Board said the average home price in the area sat at $102,000. Last month it was $1.074 million. A 1% hike from July 2021, but a 6% drop from June 2022, and that's the pricing in terms of the Toronto area. Obviously, you can see the price has been going down. The latest data from the Canadian Real Estate Association show that prices hit $629,000 nationally in July, and that's down 5% from $662,000 last July 2021. And the association forecasts that the national home price will rise 10% on an annual basis to 762,000 by the end of 2022 and hit 786,000 in 2023. And this is from Korea. I think they're being a bit more optimistic than obviously what the prices we're seeing. National prices have dropped. Prices regionally have dropped. So we're obviously going to see a continuation of this based on interest rates going to go up more. And talking about Desjardins, Desjardins did reassess their predictions just last month or in June. A trio of Desjardins economists said they expect the average national home price to fall 15% between its February high of 817,000 at the end of 2023. But because we're almost there, they adjusted their forecast in August to predict a drop between 20 to 25%. I did go over this article about a few weeks ago. I'll try to put a link in the description below. But as you can see, housing has been cooling. It's most likely going to continue to cool, and that's going to continue to have pressure on the Canadian economy as a whole. And just this week, RBC, reported their financials along with the rest of the other big banks. And you can see here RBC profit here by deal-making slump, souring economic outlook, and that'll continue to put pressure on our banks. Obviously, RBC's capital markets revenue fell a third. This is obviously based on the stock market to 1.65 billion in the fiscal third quarter. Royal Bank's investment banking revenue was slammed by plunging equity markets that dried up investor demand for initial public offering and share sales, along with 385 million markdown on loans it had underwritten. Despite the quarter's turbulent markets, trading revenue also fell, failing to counter the hit from the investment bank downturn. So can you imagine how the effect is going to continue to have our banking sector as our real estate market in Canada and obviously here in the GTA, Toronto, Vancouver, Montreal continues to slow down. And more of that is expected. As mentioned, the decision by Bank of Canada will be September the 7th, and also the U.S. Federal Reserve will be sharing their interest rate hike in September as well. And I just want to share this bit of this article with you from Nordstrom. Nordstrom reported their quarterly earnings this past week. So this is an article from Wednesday, August 24th. Nordstrom shoppers won't even buy clearance items right now, and this is based on what they reported in terms of the revenue and their quarterly results. Most analysts would agree Nordstrom has arguably the best looking department stores and customer service in the game. Even with those attributes, they don't appear to be enough, though, as U.S. customers now shun discretionary purchases like apparel with inflation raging. The stress on consumers' budget has reached the point where a trip to the sales rack at Nordstrom store or the clearance section Nordstrom rack are off the table for the time being. Execs were hinting at this on their earnings call on Tuesday. The softening trend was more significant in customer segments with the lowest income profile. This is from CEO Eric Nordstrom, stated on company's Wednesday's company's earnings call. While we see greater resilience in the higher income segments, for example, at the Nordstrom banner, items with lower average unit retail prices underperformed. Higher, average unit retail prices within our designer business and higher price luxury definitely outperformed the lower product market. So you can see this inflation has been hitting customers obviously in their pockets. Gas prices, grocery prices, you can see it across the board, to be very honest. And obviously now they're shunning or buying less of discretionary items like clothing. Even with back to school shopping, obviously, we're about a week, 2 weeks away back to, kids going to school. People are still choosing not to shop. And that says a lot. However, long-term looking, everyone still wants to buy a house, and this is a brief article here from Financial Post from Wednesday, August 24th, that Canada's millennials are still bent on owning homes, even if it means relocating. Canadian millennials remain committed to buying homes, so much that many of them are prepared to leave the country's biggest cities in order to find a house they can afford, and this is according to a survey from Royal LePage. Again, Royal LePage is a real estate broker, so take everything with a bit of a caveat. Millennials aged 26 to 24. Some 60% of that cohort aim to get out of the rental market or their basements or parents' basement, despite some of the highest real estate prices in the world, the survey said. However, of that group, 52% they would have to relocate to do so. The survey results could signal that demand for housing in smaller cities and rural areas, which spiked during the pandemic as the forced shift to remote working made working from anywhere possible, could continue even the restrictions tied to COVID-19 fall away. A huge number of millennials are telling us, yes, I will move. I could own my home, and that is very surprising according to CEO Phil Sofer of Royal LePage. We haven't seen this before, and I'm sure this is a direct result of what we saw during the pandemic, which was people slowly leaving Toronto for places like St. John's, New Brunswick, Moncton, and PEI in Montreal, as well as Calgary and BC. People are migrating, and they're obviously looking for a place where they can call a home, they can purchase a home rather than renting, and obviously being able to work remotely has a big factor in that. So that was a little bit of some positive news on the Canadian housing market. And finally, I want to summarize with what U.S. Federal Reserve said on Friday, that rates will rise until the job is done, bringing down inflation. Pretty much the U.S. Federal Reserve said on Friday that the bank's job on lowering inflation is not done, even though we've seen prints of inflation coming down, suggesting that the Fed will continue to aggressively raise rates to cool the economy. While the lower inflation readings for July are welcome, a single month's improvement falls short of what the committee will need to see before they are confident that inflation is moving down. And this is Powell's statement from Friday. And why I want to share this with you guys is as the U.S. increases interest rates, Canada will always follow, or at least have been following for the last number of decades. That's why I want to share this with you, that interest rates will continue to rise on both sides of the border, US and Canada, and definitely be prepared for that. So guys, I hope you appreciated me coming at you, and I hope you found this information helpful. 3 things I definitely want you to take away from it. Will we enter a recession? Only time will tell, but definitely it's looking that way. Obviously, real estate plays a huge factor in this, and we've seen prices cooling, sales cooling, and obviously overall activity has been dropping. And it looks like that will most likely continue, and really the biggest factor here is inflation. Where does inflation kind of come, slow down? Do we see a positive trends on a consistently monthly basis? That will really signal our end in terms of these interest rate hikes. But definitely be prepared because more are definitely on the horizon. Again, guys, I hope you appreciated me coming at you. Any likes, any subscriptions, any comments, guys, please reach out. Always encouraging and keeps me going to deliver this content to you. So have a good one, and thank you for taking the time to watch my video.